So these changes, right, the changes to like the tax credits, the new Trump accounts, the 529s, student loans, and even looking at like the government benefits for Medicaid and SNAP and all that, they're not guarantees, right? They're privileges that we're given. We have the opportunity of taking advantage of them, and there are rules and requirements around how they're to be worked, how they're to be managed. So follow the rules, take advantage of the opportunities.
Welcome to Stewardology, a podcast where two worlds collide. In this show, financial advisor Tim Russell and Pastor Drew Gysi are joined by me, producer Tyler Rutherford, to explore the intersection of financial stewardship and theology. Their unique perspectives help Christians and churches understand and apply a biblical framework for everyday financial decisions so Christians everywhere can grow in their walk with Christ through biblical stewardship. Before we get started, we just wanted you to know that the topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investment and investment strategies involve risk, including the potential loss of principal, and past performance is not a guarantee of future results. Securities and advisory services are offered through Genius Wealth Management, member FINRA, and SIPC. Without further ado, here are your hosts, Tim Russell, Drew Gysi, and Tyler Rutherford. Hi, everybody. Welcome to the Stewardology Podcast. I'm Tyler, and I'm here with Tim Russell.
Hello, hello.
And Drew Gysi.
Hey there, everybody.
Hey, before we get started, I just wanted to remind you of a couple of things. Number one, we've been going through this series on the One Big Beautiful Bill Act. It's been a crazy series. It's been a lot of fun to dive into. But remember, that bill is long and complicated. And so we actually are taking time on another podcast that we have called Life in the Markets with Life Financial Group to go into that bill in a deeper way. That video is probably already out now. So make sure you go to our YouTube channel and watch that video. It gets into the technical specifics of this bill. Instead of like this podcast, Stewardology, we focus on stewardship and the bigger implications. If you're interested in the more minutia, the getting into the details, make sure you go check out Life in the Markets. And if you're interested in getting weekly stock market updates, what's going on in the world and in the headlines that impacts these things, go check out Life in the Markets. The link is in the show notes for Stewardology. The second thing I want to remind you of is we have a book here. If you are interested in taking your stewardship to the next level, understanding the why behind biblical stewardship and getting practical steps that you can take to become a better steward, check out The Good Steward by Tim Russell and Roy Russell. That book is also linked in our show notes. Make sure you go pick up a copy, especially now that we're getting to the end of the year and we're starting to think about our budgets for next year and how we can take our stewardship up a notch. This is a really great place to start. And finally, if you've been enjoying the podcast, we would love for you to leave us a 5-star rating and review wherever you stream podcasts. That just helps us break through the noise, break through the algorithm, and reach new listeners. We would greatly appreciate that. But without further ado, let's get into this episode today, Kids and the Big Beautiful Bill.
Talking about that big, beautiful bill, Tim, give us your big, beautiful bill Trumpianism voice again. It's almost been like a staple through the series.
Not going to do it, Drew. I just tell you, I talk about this again and again, and you don't listen. You're so stupid. You have no idea. You just keep on coming back to the same thing again and again. And I'll tell you what, I'm not going to lie. I'm just getting tired of it, Drew. I'm just getting tired of saying the big, beautiful bill. It's such a beautiful bill, but I keep on saying it, and I feel like you just don't appreciate it very much.
Okay, now
It's big, it's beautiful, it's a bill. What else do you want?
Actually, I like that one.
that was good. That was both of you guys. Maybe I can do Marvin the Martian. That's about the limits of my capabilities. So, this bold legislation that it is reshaping so many different financial pieces for today and in the future for families across America. It's touching everything from tax credits to investments accounts, student loans, and even government benefits. I mean, it's sweeping. I'll use a term I like to use often because it is. This is a game changer. But it also raises some very big questions. How do we as stewards of God's blessings navigate these changes to set our kids up for success? Proverbs 22:6 says it this way: Train up a child in the way he should go, and even when he is old, he will not depart from it. Now, we're not just talking about raising kids in faith, which is very important. We must do that. But what about setting them up for practical things? What about setting them up financially in the days ahead for the future? So buckle up, stay with us as we're talking about this One Big Beautiful Bill Act and how it impacts our kids and even grandkids. So Tim, we're going to be talking about child tax credits as our first area. So talk to us about this adjustment that's taking place. We touched on it at our very first of these four.
Yeah.
So let's dive in a little deeper here.
So as we all know, the child tax credit, we were able to deduct $2,000 per child up until they're up until 18. So 17 and below, you could deduct it. You can now go up to $2,200. That's the credit for the child tax credit. But there's an income limit. For single tax filers, you only get the credit if your modified adjusted gross income is below $200,000, $200,000 or below. If you're married, they double the limit. It's $400,000 and below. So that means that a lot of people are going to see at least a 10% increase in the amount of child tax credit they get to take. So 200 to 220 or 2,000 to 2,200 is a 10% increase. That's nice. That's helpful.
Sure.
That is not a deduction. That's a credit. So that's a payment against your tax liability. That is a huge benefit for most people. The other thing to remember, as I said before, is it is a refundable credit. So if your tax liability is $5,000 and you have 3 kids, that means that you have a $6,600 credit. You get a deduction of $1,600. They take the $5,000 against your liability. You get to take the difference, the above the tax bill deduction.
And Tim, am I right in also saying that this child tax credit, they are tying in inflation to this for the future?
Correct.
To actually increase it? Am I right in saying that? So speak to that.
We don't know. There's not much I can say about it. All they say is we're going to tie it to inflation and it'll increase over the year. So who knows? Maybe the next year it'll be $2,223. I don't know. So we're going to have to see where it all lands. But there will or should at least be some kind of deduction. So just thinking through, how does this impact your stewardship? If you qualify for an increased credit, I would encourage you to pray about how God might want you to use or allocate these additional resources. If you have multiple children, this not just $200, it could be multiple sets of $200 extra money in your pocket at the end of the year. So what could you do to reduce financial stress, to build long-term savings towards your goals, not just for you, but maybe for your children? How about 529 funding or help to pay or subsidize for Christian education? There are lots of ways in which this extra money could help improve your financial responsibility and your responsibility to raise your children in the nurture and admonition of the Lord.
Yeah, just a little bit of application for you guys. Tim mentioned, taking that child tax credit that you get refunded. If that's the way it works out for you, do something worthwhile. My wife and I, we took our entire tax refund the first year that we got it when Marilyn was born, my daughter. We opened up a 529 with the whole amount. And man, that's awesome to be able to look back and see how much it's grown. And so I do encourage you guys, make it worthwhile. Don't squander it.
Yeah. Well, the next thing in this bill that affects kids is the famed Trump account. And man, let's talk about some really great marketing. We have Obamacare, and now we have the Trump account. The Trump account is essentially an account that allows for tax-deferred savings for the future of a child. We are allowed to contribute up to $5,000 per child into this account. And the government will put in $1,000 for children who were born between 2025 and I think it's 2028.
Hey, Tim,
Yes.
quick question. That $5,000 that you can put in, Is that $5,000 an initial 1 year thing, or is that per year
No,
you can
that's
put in?
every year. You can
So
put
that's
that
important.
in every year.
That's important
Yes.
to know that.
The
And who
$1,000 that the
puts that
government
in?
the $1,000 that the government puts in is a once and done thing.
Okay.
But and we're not sure when that's going to happen, and we're not sure how it's going to happen.
Right.
There's a lot of yet to be determined. You may actually have to file for it and get it as a credit in your tax return, and then you're expected to put it in as a government thing. We don't even know.
And it'll probably be tied to the child's social security number.
Yes, yes. It is. So there's a lot about this that we don't yet know, but the $5,000 is an annual limit. You can put $5,000 in this year and next year and the year after. And I say you can put it in this year, maybe if they figure out how these are structured and how to open them and where they're going to be housed. I hope to the Lord that they're not housed at the Treasury Direct or whatever, treasurydirect.gov. That's such an antiquated website.
Yeah.
I don't know. This whole thing is they of, we'll have to wait and see. Mm-hmm. We don't really know who's eligible. Well, we got U.S. citizens are eligible. If they get the $1,000 if they're born between 25 and 28, 2025 and 2028, but you also have to somehow apply for the account. So it's not necessarily automatic. There are contribution limits, or actually the contribution limits, we talked about $5,000, but contributions are not deductible. So we have after-tax money going into this. So Tyler, let's just pick on you. Let's hypothetically say you and your spouse are making $80,000 a year, and you put into the Trump account $5,000. Well, you're taxed on $80,000. You don't get a deduction for that. But the money in that account then grows tax deferred. It's not like a Roth IRA. In a Roth IRA, you make 80, you put 5,000 in Roth, it grows tax free. This, you make 80, you put 5,000 in an account, and it grows tax deferred. So you don't get to deduct the money that you put into it, and the growth isn't tax-free, it's simply tax-deferred, which means that this account will have a combination of taxable and non-taxable dollars, and you have to remember how to keep that all straight. I hope they have a method to figure this out and to track
I
that
liked your
basis.
face. For people listening that did not see your face, that was golden, Tim.
Yeah. There's so much about the government trying to do things and just making everything way more complicated. Now, as far as the investment options for this account are pretty interesting. You are supposed to use only U.S. equity index funds, things like maybe a Dow Jones indexed fund or an S&P 500 fund. Like that's all you can invest in. You can't invest in stocks. You can't invest in mutual funds. It's got to be usually it's ETFs or mutual funds with super low cost bases, or not cost bases, it's cost structures. They actually have a requirement. Can't invest in something that costs more than X amount. So that's weird. The other thing to know is that you can't work with a financial advisor, as far as I know, to open these or maintain these accounts. These are on your own, and you can't change your investments. Like it is what it is. You can't invest in anything but the S&P 500. So those are factors. Be aware.
When I was hearing that, not just you saying that, but I heard this before, I thought that was an important piece because we talked about this in our last episode about millionaires and billionaires. Is it for them or is it rocket fuel for the economy? What this does is it pours money into American companies and it helps them thrive, hopefully even more, and see even greater
You're talking
growth.
about buying an index fund?
Buying an index fund to be able,
sort of.
I think it's that. Think about that.
Yeah, no, it's not as nice or as neat as you're laying it out to be.
Well,
in an index fund,
explain.
you're putting in a fractional amount of money into like all 500 of the biggest companies in America. So the S&P 500. That amount of money is not going to move because the size of them and the amount of money we're talking about, it's not going to move the needle. We're buying shares on the secondary market. The money isn't going to the company. It's going to whoever sold the share. So it's not actually going into the pockets of businesses. Now, there certainly is an economic impact for having a market where there are people willing to buy the shares of that company through an ETF or a mutual fund. So I don't deny that there is some benefit to a company to have people being interested in buying it. But the revenue or the money from the sale of that stock doesn't go to the company. It goes to whoever sold it. So I own shares of, let's say, Apple, and you're the index fund. You want to buy Apple from me because you need to have so many shares of Apple to meet the index. You're buying it from me. So you give me $200 a share for Apple. That goes into my pocket. That doesn't go into Apple's pocket. So it doesn't necessarily juice the economy like you were suggesting. It's not quite as neat as that.
But even though I just looked up in 2024, 3.6 million births were here in the United States, and they're anticipating it right around that same, give or take.
So let's say $2.6 million.
3.6.
So 3.6 million times 1,000, right? We're looking at not chump change, a lot of money, but it's divided between 500 companies. So, and it's not going to make, it sounds like a big number. Yeah. It's not going to make a big impact.
I see what you're saying. It's not going to move the needle in a big way.
No.
But what I do like, it's investing in American companies.
Yeah. They're investing in American companies or companies that are traded on the American Stock Exchange.
Yes.
And that's not necessarily the same thing.
Correct.
And then the other facet to consider about this is that a lot of these U.S. companies are not just making their revenue from America, they're making their revenue from all across the country. Coca-Cola is a good example of this. Yeah. What is the percentage of the revenue that Coca-Cola makes that comes from America? It's less than 50%. I think it's closer to 30%. So 70% of the revenue comes from the rest of the world. So that's not to say that's a bad thing. I'm just pointing it out. It's not like it's all just going to America. So bear that in mind. All right, let's keep on going here. There are a number of things that are not entirely clear yet. So there are some rollover options. When the child is 18, half of the money becomes available for use for certain qualifying expenses. Once they're 25, any unused amount can be rolled over into possibly an IRA or retirement plan of some kind. But then we've got the question, traditional or Roth? And do we have to divide part of it to traditional and part of it to Roth? Because part of it's treated as traditional and part of it's treated as a Roth. We don't know. So there's a lot of interesting things. Well, what about a 529? Can it be rolled to a 529 plan? Yeah, probably it can. Who owns the account? How does the whole thing work? There's so much that we still have to figure out. So here's the thing I think is probably helpful to be aware of. This does not have income caps. So if you are a family of wealth, if you have the money to put into these Trump accounts, it's a great way of starting to throw money under the kid's name and see that money grow and kind of really give the kid a leg up as they go through life. So I can see this as something that individuals who are moderate to higher income are going to take advantage of. I think lower income individuals are going to take the $1,000 and probably do nothing else with it. And if that's all they do, that's a good thing. But just be aware, there's no cap on the income for this. That may change in the future, but this could be a good thing for just kind of putting money into the ownership of children of these families.
All right, so I just ran some numbers, and if you get this $1,000 from the government, the Trump account, at age 1, and you plan to withdraw the money at 18, and it grew at 8%, what does that grow to? Well, if you don't put anything else in this account, it grows to about $3,900. If you go 10%, which is probably a little bit more close to what we actually see in real life, it's about $5,500 by age 18. Now, what if you left that in, just the $1,000, you didn't contribute anything else to it, and you waited until they were 67 at a 10% annual return? It grows to about $715,000. That's wild. That's a lot of money. Of course, past performance is not a guarantee of future result.
Yep.
We have to say that. But this does go to show that there is a significant opportunity.
The magic of compound interest.
Yeah, there's definitely opportunity there.
Well, let me just wrap this up with what's the action step you should take? What's the stewardship action step? Stay tuned. Pay attention. Yeah. And if you have a child born between 2025 and 2028, I would look to take advantage of getting that $1,000 in the account, opening the account, doing whatever is required to do that. I say do whatever is required because we don't know yet. Yeah. We still have to stay tuned to learn more. Over the next months, we will have more information to be able to proceed.
So what about 529s? I know we briefly mentioned this in the first episode of the series, but what are the expanded 529 benefits?
So the current limits is that it's primarily for college expenses, but you can take up to $10,000 for K through 12 expenses. So if you put your kid in a private school and it costs $8,000, you can deduct the $8,000 from the 529. Under the new bill, you can actually take that number up to $20,000, which is handy. So this would be good if you're like, grandparents are kind of trying to fund it. If you have a lot of money in the 529, I personally, I have my kids in private school. I have a 529. I didn't use any of the 529 for K through 12 education, primarily because I was trying to save it for college. My kids are in college now, and now's the time I need that 529 to be able to cover the bills, because the bills are times of multitude larger than what they were when they were in private school.
Because you have two at the same time.
At the same time.
That's
a big deal.
Yep.
So there's a benefit there. It's expanded to $20,000 for eligible expenses, and they've expanded the list of what those eligible expenses are. So let me just break it down for you. We've got curriculum materials, textbooks, and homeschool resources, private school tuitions, trade schools, vocational certificates, and apprenticeship programs. Next one is really interesting: tutoring services, standardized testing fees, dual enrollment fees, and educational therapy. So these now are eligible or qualified expenses that you can take the money out of a 529 and have tax-favored treatment of that. The tutoring, just a note there, there's a whole list of who eligible tutors are, and it can't be like a family member. It's got to be someone who is in the business of doing tutoring. That's, not mom sitting there and charging and taking money out of the 529. Sorry, mom, you can't do that. Nice try. The annual contribution limits are tied to the annual gifting limit. So the annual gifting limit jumps up to $19,000 per person in 2025, which means that you can put in a lot of money into the 529 if you had the means to do so. Just thinking through here, what are the action steps you should take if you're thinking about 529? I would encourage you, if you have children, you're looking for the future, you've got that, we talked about this a moment ago, you got that larger child tax credit. I would use any tax breaks or cuts that you get from the new big, beautiful bill. I'd open a 529 plan and start funding it. College is expensive. If you don't use it for college, under the new tax code or an update they put through a couple of years ago, you may be able to use some of that to fund a Roth IRA. So even if they don't end up going to college, it can still be beneficial.
So the next thing is student loan changes. Now these I think are sweeping. These are big changes to student loans.
Major changes.
Yeah, so there's a couple of things. The first one is Parent Plus loans. So in the past, parents could, generally speaking, borrow the entire cost of a college education on behalf of their kids. Dangerous. And go that route. Well, the new law, the new tax bill, puts a limit on that. Now it's $20,000 per year per student, with a lifetime limit per student of $65,000.
Well, that's interesting.
Yeah.
Because if it's a 4-year program,
4-year degree,
it's not the 80, it's
But I will tell you,
60.
I like that thinking. It forces out-of-box processing to actually cover the cost of this. I actually think it's a genius move.
I also agree. I think it's a good idea to try to reduce the amount of borrowing. I do, however, have questions. It says it's a lifetime limit of $65,000. Is that based on origination, or is that based on outstanding balance? Because one of the things about the Parent Plus loan, as opposed to a regular student loan payments are deferred until graduation, like 6 months after graduation when you have to start making repayments. Parent Plus loan repayment starts right away. So if you're in year 4 and you've already paid back a certain sum of money, it may simply be that like you can do 4 sets of $20,000 and still owe 65 because you've been paying in all along. So it's a little unclear to me whether it's the borrow amount, you can't do more borrowing principal amount borrowed more than $65,000. I'd be curious to learn more about that.
Yeah, and there's differences too between like federal subsidized loans and federal unsubsidized loans. I think subsidized loans are the ones where the interest is deferred 6 months after graduation. Unsubsidized, the interest starts accruing right away. So those are things to consider. And I think for graduate programs, you cannot use these subsidized loans anymore. I think they're going direct unsubsidized.
I think we're going to touch on that later.
Loans, yes. But that's important to know, though, because, my wife went through the program, getting her bachelor's and her master's and her doctorate, and we got all these kinds of loans now, and how do they interact with one another? How do we pay them? Payment is interesting. There are some changes with income-driven repayment plans. In the past, I mentioned this in the first episode on this series, in the past, there's a bunch of different kinds of options you have when it comes to paying your student loans back. And they're all really niche and interesting. Well, all of those are going to go away at a certain time. I believe it's next year. New borrowers will not be able to access the old payment plans, but it's going to be replaced with 2 things. One already exists. It's the standard repayment plan. This is when you pay a fixed amount on your loan over the course of 10 years. That's kind of the most common. It could be even more, like maybe even 25 years. But generally speaking, 10 years is the most common. And then that is set up so that your loan is paid off after 10 years. It's gone. You've paid it. It's done. The other option they are setting up is called a repayment assistance program, where this repayment plan is tied to your income, like anywhere between 1 to 10% of your income. And you're going to pay that for, I think it's like 30 years. And after that 30 years, the promise, and I put promise in air quotes, is that the loan will just be forgiven. Be really, really careful, because historically speaking, only about 5% of loans that fall into the category that could be quote unquote forgiven are actually forgiven. Okay, so I'm going to be a little bit tough here, but the hole that was dug is your hole. We got to dig out of it, right? We can't depend on the government to take care of that loan for us. There's also some changes with deferment status. So in the past, if you stumbled upon economic hardship or financial hardship, or you were unemployed at a job, you got laid off or something, you could defer your loans, meaning you stop paying it. You're not required to make a payment, but the interest will still grow over time. I believe it's a lot harder now to access deferment options. I don't think they're impossible to get, but I think the exceptions for economic hardship and unemployment are either completely gone with, or it's very hard to access.
Yeah. It says it's available, but with stricter limits, stricter time limits.
Exactly. So you take out a loan, we have to make sure, this applies like every other loan. If we take out the loan, we have to make sure we can pay it back, that we have a strong plan that we can pay back this thing. Now, there are other loan caps, and I'm not going to get into those things. Just it'd be boring to go through it. But essentially, if you're an undergraduate borrowing federal loans, there's a cap to how much you can borrow.
$100,000.
$100,000. I think it's is it $200,000 lifetime, or let's see, for a professional degree. Oh, so this is graduate programs. For a professional degree, you're capped at a certain amount. It's $200,000 lifetime, or $50,000 a year. For undergraduate, you're capped at $100,000 lifetime. And again, this is federal loans. I want to make sure we know that. There are private loans, and there are pros and cons to all of these things. Just be careful. Know what you're signing up for. That's really what I want to get across, is you need to know what you're signing up for.
So just a couple thoughts for us as we're kind of working through this. Number one, it sounds like a bad deal. They're making it harder to go to college, right? No, actually, I don't think they're making it harder to go to college. College is already hard, and it's hard not just to go through college, but to go through college and come out with all that debt and try to think about life afterwards.
Yeah.
Man, be careful what you wish for. Trying to live with a mortgage size student loan and only having an entry level salary could be devastating to a family's finances. Drew, I know you meet with people all the time, and it is not uncommon to see people in their 60s still dealing with student loan payments from 20, 30 years ago.
I do see that, and that it just shakes me to the core, because they may have gone through a couple times of deferment, or they're just paying the minimum balance, and they're 30 plus years into paying this. And I'll even go as far as saying, I remember a couple I met years ago out in the Midwest, and here the parents, they're in their 70s, they took out student loans for their kids, and they're barely making it. Their kids are doing okay, got good jobs and doing professional work, but the parents took out the student loans, and they're in their 70s still making payments on this thing.
Probably still working and not able to really retire.
Yeah. They are.
Yeah.
So this student loan thing, I think all three of us can speak intelligently to this about the blessing it can be, but more so the curse it is.
Yes.
Yeah. First of all, if your parents are on your student loans, refinance and get them off if it makes sense. Yeah, that's the first thing we did when we got married. Was her mom was on one of those loans, and at the time, we were dealing with her dad was sick with a terminal disease, and they're already like struggling there. The last thing we wanted is a hardship on our end to impact them, right? So we did what was responsible, in my opinion. We refinanced and got her off of that loan to protect her. Right. But at the end of the day, the student loans, they can be dangerous. You need to know what you're getting into and understand it. The other thing I wanted to say is if you're in that situation where let's say you've borrowed $50,000, you've paid back $70,000, and you still owe $90,000, it's probably because you're on the income-driven repayment plan, paying the minimum payment. We got to get off the minimum payment. We got to make more than the minimum. If that means getting a bigger shovel, a bigger income, we got to do that, because the income-driven rate, we can't bank on the government forgiving whatever's left.
No,
right?
It's a terrible idea.
Exactly.
Okay, so just a couple points more of admonition to us as we're thinking about loans. One of the concerns I have is they're making it more difficult to get federalized subsidized loans. And love them or hate them, and I hate more than I love about these. They're at least regulated, and there are rules about how they operate, which means that if you still are intent on borrowing the money to go to college, you may find alternative lending sources. And my fear is that we'll have a cottage industry of predatory lenders who will step in and do even worse than what the federalized subsidized loans were doing for students. So bottom line is be super, super intentional to create alternative funding methodologies. And by that, I do not mean loans. I mean creative about work and study, about scholarships, about slowing down your education to make it affordable for you so that you do not have a mortgage-sized debt when you leave school. So be very cautious about a potential cottage industry of predatory lenders coming out and giving you non-federally subsidized loans for school that don't hit the books.
Amen.
I want to just do a quick plug. This is a movie that all of us have watched. And Tim, you thought it was so powerful that we shut down our office, all gathered in our conference room, and we watched it. And it's a movie that's put out, a documentary done by the Dave Ramsey Group.
Yeah.
And
Borrowed
it is called
Future.
Borrowed Future. It's on a lot of different streaming platforms. I want to encourage parents, go out, sit down with a laptop away from the kids. The two of you watch it together.
I would show the kids.
Well, here's what I encourage parents to do. Let the two parents sit there, watch it together, or if you're a single mom or dad, watch it alone. Process it. And then after you have that done and you've talked about it, you've processed it, then sit down and watch it again with your kids. I got more out of it the second time I watched it. And I can't stress this enough. Take some time, watch that movie, package it in your heart and mind. Sit down with your kids, give them the popcorn, sit down, watch it, and cause them to then interact with you afterwards about that. And I would say, don't wait until they're 17 years of age, because that may be too late. Start earlier, and maybe in their early teens or preteen, so they start processing. If they start talking about this higher education, talk to them about that. But can I say, I don't want to give away the movie, but it is so well done. It causes you to think and process through this whole debacle of student loans and the higher education process.
So in summary, I think there's some good things here with limiting and capping borrowing. I think it's helpful. I think a lot of people would have been helped had this been done 15, 20 years ago.
Absolutely.
Let's move on to the next category, Medicaid and SNAP benefits. We've addressed this in prior episodes a little bit, but there are some reductions in these categories. And the fear is that this one big, beautiful bill is going to hurt kids. It's going to take food out of their mouths. It's going to cause more food insecurity. It's going to take medical benefits away from kids, and that's going to result in maybe putting them at risk medically. Is there truth to any of this? What do we think about these particular issues? Drew, you want to take a stab at it?
Well, I think there is truth to this, Tim, but it's going to be more so for those that are here in the country that do not have legal immigration status, because they're not going to be able to have that accessibility to some of these things. And that's where I'm going to highly recommend, as needed and necessary, different nonprofits will step up and be able to take care of things like this. And please do so. Support that if that is what you want to do, and how you want to use the kingdom money that God has given you. I'm all for helping people in need, especially when there's a gospel presence that's there.
Sure.
So that's one of the things that's there.
But the bottom line is that this bill is not intentionally targeting kids,
Exactly.
as some have portrayed the bill to be.
Right.
There are impacts on children. Nobody wants children to go hungry, though. Not even Donald Trump, believe it or not. He doesn't want kids to go hungry either. However, we do have to recognize the broader effect of we have to address the national debt and prioritize legal residents over illegal residents.
And as stewards, we're also called to balance that compassion that we have to have, along with the responsibility that we have at the same time. Matthew 22:21 says, "Render to Caesar the things that are Caesar's, and to God the things that are God." This verse reminds us that we are to respect the governing authorities and keep our hearts aligned with what God has called us to do, which is, we see littered through Scripture, is to be a blessing to those that are vulnerable, to those that are in need. And this one big, beautiful bill, the changes there, almost certain will spark debate. We're going to see even more and more of it. It's going to happen on the Congress floor, and it's going to happen in the local workforce. You're going to hear different debates on there. But the premise of this bill is to highlight the importance of legal immigration, fiscal responsibility, along with caring for those that are legal citizens, Tim, just as you said. So for more Medicaid spending, check out a couple episodes ago, number 256. We actually dove a little deeper into it there, and I think that'll give you a better roundabout piece about this idea of this Medicaid and SNAP benefits for kids.
So these changes, right, the changes to like the tax credits, the new Trump accounts, the 529s, student loans, and even looking at like the government benefits for Medicaid and SNAP and all that, they're not guarantees, right? They're privileges that we're given. We have the opportunity of taking advantage of them, and there are rules and requirements around how they're to be worked, how they're to be managed. So follow the rules, take advantage of the opportunities. You are a steward. You're called to be aware of these things and take advantage of them as you are able to do. So use wisdom, use faith, be generous with how you approach what this is going to mean to your bottom line. Remember Philippians 4:19, as it says, "And my God will supply every need of yours according to his riches and glory in Christ Jesus." Whether you are thinking about that extra $200 a year you might get per kid, or $1,000 in that new Trump account, generosity to the local church, to local Christian charities, and to help bless others is something that honors God, is something that we're called to do to show the love of Christ towards others and even towards our kids. So let's use the resources and the opportunities that God places before us to demonstrate the love of Christ to the world and to be a good steward of what he has. So what's your next step? Let's take the time today to pray over all the different opportunities presented to you, the challenges in this bill, and put your finances and your family before the Lord. We do not have confidence in the future because Biden had a tax bill or Trump has a tax bill. We do not have our confidence in the future on that. We have our confidence in God's promises. What was that promise we just said? And my God will supply every need of yours according to his riches and glory. An aside here, notice that Jesus is giving out of his wealth, not of the wealth of others. I kind of love that. But we can have confidence in the future because God is good. Now, he has promises unfailing love to us, to your family, to your children. So take heart, my brothers and sisters. Pray over what God would have you to do with applying these for the benefit of your family, your children, your community, and this world. And God will be glorified. Until next time, take care, God bless, and remember that my God will supply all of your needs according to his riches in glory in Christ Jesus. Goodbye.
Thanks for joining us on the Stewardology Podcast, where financial stewardship and theology meet. We'd like to help you take your next steps in biblical financial stewardship. Subscribe in your podcast provider to get the newest episode delivered to you every week. Leave a 5-star rating and review to help new listeners find the show. Take advantage of your free personal stewardship review at stewardologypodcast.com/review. Be sure to follow us on social media and visit our website at stewardologypodcast.com for tons of free resources and hundreds of free episodes. You can also leave episode ideas at stewardologypodcast.com/idea. Remember, Psalm 20, verse 7, some trust in chariots and some trust in horses, but we trust in the name of the Lord our God. See you next week.